We are at 94.63 on Brent crude. In the last few hours we've ripped 3.41%. The headline says Trump just vowed more attacks on Iran, and that's your first danger. Because while the war bid smells like an explosive breakout, the data underneath is setting up a textbook bull trap. I'm going to show you exactly why, and I'm giving you the 3 precise trade setups that will make money when this war premium gets priced, or violently repriced. Stay to the end. You'll walk away with the one number that decides whether we collapse to $89 or scream to $98.90 before the week is out. Pause. This is Alpha Market Meridian, and you're about to see the Brent oil chart the way institutions see it, right now, instant market verdict. The session bias is a fading rally. Yes, the 1 hour and 5 hour trends are a strong buy, but we are driving straight into a wall of weekly and daily resistance that has swallowed entire geopolitical spikes before. I am treating this surge as a counter-trend squeeze within a neutral daily and weekly structure, until proven otherwise. There is one invalidation level that flips everything. Write this number down. A daily close above 97.09. That is the 50-day moving average, perfectly stacked on top of the 20-day moving average at 97.07. If we close above that cluster on the daily candle, the entire bearish structure resets and we are chasing 98.90. But if we fail there, and history says these war premiums fail more often than not, we are looking at a fast unwind back through the 94 pivot. Here's what the herd is doing. The consensus right now is piling into long positions because the headline feels urgent. And that's exactly why the trap is so dangerous. The CFTC positioning data has already shown funds adding length into last week's dip, and today's spike is reinforcing that bias. When everyone is already long and the catalyst is a fleeting political statement, the squeeze higher runs out of fuel exactly where the big moving averages sit. So know this. The 97.09 line is where the bulls get tested. If you're long here, your edge is thin. Let's walk the charts from the top down. Weekly, daily, 4 hour, 60 minute, because the structure is screaming a message that most retail traders are missing. Start with the weekly. The weekly trend is neutral, but the moving averages tell the real story. The 200-week moving average is way down at 83.91. That's the big gravity line that pulled price last year and held every major sell-off. We are currently $10 above that, which gives the weekly chart a higher-low sequence if you squint, but we've been making lower highs since the 98 handle. Now, the 100-week moving average sits at 92.06. Earlier this week, we tagged right into that level and bounced, a mechanical reaction. That bounce is now being extended by the Iran headline. So the weekly context, we bounced off the 100-week MA and are now attacking the 20-week and 50-week moving averages that cluster dead between 97.07 and 97.09. That is the battle zone. Step down to the daily. The daily chart is neutral, no clear trend, just a sloppy range between 89.20 support and 98.90 resistance. The moving averages on the daily are the same cluster, MA20 at 97.07, MA50 at 97.09. It's uncanny how precise this overlap is. Below us, the 5-day moving average just crossed 93.80, the 10-day is at 95.20. Price is above those shorter averages, which give short-term momentum a bid, but the heavy resistance is less than $2.50 away. On the momentum side, daily RSI is only at 45. That is not overbought. It's actually still in the lower half of the range. That means the bounce can technically extend another $4 or $5 before we hit overbought territory on the daily, but we need to see what MACD is doing. Here's what most traders miss. Drop to the 4-hour chart. This is where the hidden divergence lives. Look at the price action since the overnight low, a massive impulse candle straight up through 93, then 94.05, hitting 94.63. But pull up the MACD on that exact 4-hour window. The MACD line is still negative at minus 2.260. The histogram is trying to tick higher, but the slope is weakening relative to the prior spike we saw 2 weeks ago. In plain language, buyers are exhausted even though price is printing a higher high. This is classic hidden bearish divergence. Institutional algos use it to fade emotional spikes. When price makes a new high but momentum trails, the move is running on fumes. That's your first yellow flag. Now the 60-minute chart is a strong buy, ADX at 35, so the short-term trend has muscle. But CCI is still deeply negative at -91, which tells you the burst is coming from a very compressed state. So the 60-minute structure supports a push into the 96.66 to 97 area. But that's exactly where the trap sets. Support and resistance levels precisely. Daily pivot sits at 91.81. Key support, S1 at 89.20, S2 at 86.96, S3 at 84.35. Resistance, we already broke a 1 at 94.05. Next is a 2 at 96.66, and a 3 at 98.90. This is the grid, and right around the 3-minute mark, here's the insight that separates winners from losers. This rally isn't being driven by a real supply disruption yet. The war premium gets priced fast, and then fades equally fast unless physical flows are actually threatened. Right now, that's not happening. The market is trading on a headline, and that headline is fragile. Now connect the fundamental driver and the cross-asset linkage. The last 24 hours, the single core news shaking Brent is Trump vowing more attacks on Iran. Immediately, oil leapt, but this comes with a simultaneous release that crude in the Strategic Petroleum Reserve just hit its lowest since August 2023. That's a double-edged sword. A tight physical market gives a fundamental flaw. Inventories are not overflowing, but the SPR drawdown also signals that the US has less emergency cushion, which ironically makes any actual supply shock more dangerous, yet the political willingness to release more barrels is diminishing. So the physical backdrop is quietly bullish in the medium term, but the war bid itself is a sentiment spike that almost always retraces unless the Strait of Hormuz is actually threatened. We've seen this pattern at least 6 times in the last 2 years. Now look at cross-asset linkage. Brent is moving tick for tick with US equity futures softening. The S&P is wobbly this morning. VIX is elevated, which normally would pressure crude lower on demand fears. But today the geopolitical fear is overriding demand destruction signals. That divergence cannot last. Either equities stabilize and oil maintains a risk on bid, or the growth scare reasserts and oil's war premium collapses into the demand fear trade. Meanwhile, the dollar is weaker on the session, which supports crude in dollar terms, but dollar weakness tied to tariff uncertainty is a growth negative signal. So the net web is fragile. My 1 to 2 week directional lean is cautiously bearish on Brent, expecting a fade from the 97 cluster back toward the 92 area. The exact event that invalidates this lean, a weekly close above 97.50. If we see that, the entire narrative shifts to a structural breakout. Do you think Brent hits 97 this week? Drop a comment right now, just say yes or no. I'm tracking consensus live, and I'll reference the herd bias in tomorrow's video. Now we move into the trade setups. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to hand you 3 exact plans with entry triggers, stop losses, and risk-reward ratios you can screenshot and trade tomorrow. The market is giving us a rare situation, a momentum burst into a brick wall. That means we can design plays for both the fade and the breakout failure. Strategy number 1, the sniper, conservative. This is the high probability fade from resistance. The trigger condition is this. We need Brent to rally into the 96.90 to 97.09 zone and show a clear rejection candle on the 1-hour chart. Specifically, a 1-hour close below 96.20 after a spike above 96.66. That confirms the sellers are stepping in at the moving average cluster. Once that trigger prints, you enter short on a limit at 96.40, or aggressively on the close of the rejection candle. The stop loss goes above the R3 resistance and the recent swing high, exactly at $99. That's above 98.90, giving room for a false breakout without getting chopped. The logic: if the market accepts price above 98.90, the structure has changed and we do not want to be short. Target 1 is the broken R1 turn support at 94.05. That's a $2.35 move from entry. Target 2 is the weekly 100 MA and psychological support at 92.00. That gives you a risk-reward ratio of roughly 1 to 2.3 on the first target and 1 to 3.5 on the second. What voids the setup entirely? A daily close above 97.50. If that prints, the moving average cluster is broken, and the sniper short is dead. Take the loss small and flip long the sniper, conservative, entry. 96.40 on 1H close below 96.20 after spike above 96.66 stop loss. 99.00 take profit 1. 94.05 take profit 2. 92.00 risk, reward. 1:2.3 R to TP1. 1:3.5 R to TP2 invalidation. Daily close above 97.50 before we go to the active play. Type your Brent range for tomorrow in the comments right now. Give me a high and a low. Let's see who's aligned with the institutional order flow. I read every comment. Strategy 2, the active trader, standard. This one is for those who want to trade the breakout if the trap fails. The entry condition is a confirmed daily close above 97.50, but you don't have to wait for the daily close. You can enter on a 1-hour candle close above 97.15 with strong volume, targeting the momentum continuation. The stop loss sits below the breakout level at 96.50, just under the cluster, because if the breakout is real, price should not come back into the prior resistance zone. Target 1 is a 3 at 98.90, a clean level with 175 ticks of profit potential. Once target 1 is hit, trail the stop to break even and let the runner go to target 2 at 100.00, the psychological century mark. The risk-reward on this setup is roughly 1 to 2.5 before the runner. Invalidation is a swift rejection that closes back below 96.50 on a 4-hour basis. That means the breakout was a head fake and you cut it the active trader, standard, entry. 97.15 on 1H close above with volume stop loss. 96.50 take profit 1. 98.90 take profit 2, 100.00, trail stop to break even after TP1, risk, reward, 1:2.7 R to TP1 invalidation, 4H close back below 96.50 now. The third strategy is the aggressor, high risk. This is a counter-trend long on a pullback, playing the fact that the short-term momentum is still extremely strong and the physical market is tight. If price pulls back and tests the broken A1 at 94.05 and holds, you can enter long with a tight stop. The entry is a 1-hour bullish engulfing candle off the 94.05 to 94.20 zone. Stop loss goes at 93.40, just below today's VWAP and the 5-hour moving average support. If that breaks, the bounce structure is damaged. Target 1 is the midpoint of the resistance zone at 96.00. Target 2 is the cluster itself at 97.05. Risk reward. You're risking 90 ticks to make roughly 210 ticks to target 1. That's a 1 to 2.3 reward. This is only for those who can lose small and manage risk aggressively. If oil gaps down below 93.40 on a headline reversal, you're out instantly, no questions. The invalidation is a 1-hour close below 93.30. This setup works because the ATR is over $4, so an intraday swing can easily hit those targets if the war bid sustains. The aggressor, high risk, entry. 94.40 on 1H bullish engulfing from 94.05 94.20 zone stop loss. 93.40 take profit 1. 96.00 take profit 2. 97.05 risk, reward. 1:2.3 R to TP1 invalidation. 1H close below 93.30 risk management pulse, 30 seconds. Never risk more than 1 to 2% of your account on any single oil trade, especially when the daily ATR is above $4 and a headline can gap you. No positions through high-impact news events like EIA inventory numbers or sudden geopolitical escalations. Stops are non-negotiable. Survival is the edge that lets you trade the next big move. And the next big move in Brent is coming whether this breakout holds or fails. Now let's close this out and lock in a plan. The single most critical level for the next session is 97.09. A daily close above it flips the whole board to a breakout chase. A rejection there sends us straight back to the 94 pivot and likely lower. Tomorrow's wildcard. We get whispers ahead of the OPEC Plus meeting and the US inventory data. That inventory print could be the pin that bursts the war bubble if it shows another build against the demand fear backdrop. I'll be breaking down the S&P 500 and Bitcoin divergence video right now. Tap the end screen and watch how risk assets are reacting to the same geopolitical pulse. If this Brent plan gave you clarity, smash the like button, subscribe, hit the bell, and type the word trap in the comments if you see the bull trap forming. I'm watching the charts alongside you. See you in the next one.